Have you ever looked at retirement calculators and felt discouraged by the enormous number they tell you that you need? Maybe you've heard that you need $1 million, $2 million, or even more before you can comfortably retire. For many people, those numbers feel overwhelming. They create stress, anxiety, and the feeling that retirement may never be achievable. But what if there was a smarter way to think about retirement income? What if the amount of money you need for retirement isn't just about building the biggest possible portfolio, but about using your money more strategically? That's exactly where the bucket strategy comes in. Today, we're going to explore how a bucket strategy can potentially reduce your retirement savings goal by as much as 25% while helping you feel more confident about your financial future. We'll discuss what the bucket strategy is, why it works, how retirees use it, and how it can help create a more reliable retirement income plan. Before we begin, if you enjoy practical retirement, Social Security, and financial planning content designed to help you make smarter money decisions, be sure to subscribe to the channel and turn on notifications. We regularly share simple and actionable information that can help you build a more secure financial future. Let's get started. One of the biggest mistakes people make when planning for retirement is focusing only on a single large savings number. Many financial headlines tell people they need a certain amount of money to retire. Some articles say $1 million, others say $2 million. Some suggest even larger amounts depending on inflation and lifestyle expectations. While these estimates can be useful as rough guidelines, they often ignore something very important. Retirement isn't just about how much money you have. It's also about how your money is organized and used. Two retirees with exactly the same portfolio value can have completely different retirement experiences. One person may constantly worry about running out of money, while the other feels comfortable and financially secure. The difference often comes down to strategy. This is where the bucket strategy becomes valuable. The bucket strategy is a retirement income approach that separates retirement savings into different categories or buckets, with each bucket serving a specific purpose and time horizon. Instead of treating your entire retirement portfolio as one giant account, you divide your assets according to when you'll need the money. Typically, retirees create 3 buckets. The first bucket contains cash and short-term assets that will be used for immediate expenses. The second bucket contains conservative investments designed to provide income over the medium term. The third bucket contains growth-oriented investments intended to support long-term retirement needs. By separating money this way, retirees often gain greater flexibility and confidence. Let's look at the first bucket. The first bucket is your short-term spending bucket. This bucket usually contains enough cash or cash-like investments to cover 1 to 3 years of living expenses. Examples might include savings accounts, money market accounts, short-term certificates of deposit, or treasury bills. The goal of this bucket is stability. This money is not intended to generate high returns. Its purpose is to provide spending money regardless of what happens in the stock market. If the market experiences a downturn, you can continue drawing income from this bucket without being forced to sell investments at unfavorable prices. This is one of the biggest advantages of the bucket strategy. Many retirees fear market crashes because they worry about selling investments during periods of decline. The bucket strategy helps reduce that concern. Now let's discuss the second bucket. The second bucket is typically designed for medium-term needs. This bucket often contains investments such as bonds, bond funds, dividend-paying investments, and other relatively conservative assets. The money in this bucket may be intended to support retirement spending during years 4 through 10. While this bucket seeks growth, its primary focus is income and preservation. It serves as a bridge between short-term cash reserves and long-term growth investments. The third bucket focuses on long-term growth. This bucket may contain stocks, stock funds, index funds, and other investments with higher growth potential. Since this money may not be needed for 10 years or longer, it has more time to recover from market fluctuations. Historically, long-term growth investments have provided higher returns than cash and bonds, although they also involve greater volatility. By giving this bucket a longer time horizon, retirees can potentially capture growth opportunities without relying on those assets for immediate spending needs. Now you may be wondering how this strategy could reduce a retirement savings goal by 25%. The answer lies in efficiency. Many traditional retirement calculations assume that retirees will need to maintain a large portfolio capable of supporting withdrawals, regardless of market conditions. As a result, people often save more than necessary because they are planning for worst-case scenarios without considering how strategic asset management can improve outcomes. The bucket strategy creates flexibility. Because short-term spending needs are already covered by cash reserves, retirees may feel less pressure to maintain excessively large portfolios. They are less likely to panic during market declines. They are less likely to make emotional investment decisions. They are more likely to stay invested during periods of volatility, and that can improve long-term results. One of the greatest threats to retirement success is not necessarily poor investment performance, it's poor investor behavior. When markets decline, many people become fearful. They sell investments. They move entirely to cash. They abandon long-term plans. Unfortunately, these emotional decisions can lock in losses and reduce future growth potential. The bucket strategy helps address this problem. Knowing that several years of expenses are already set aside can provide peace of mind during difficult market periods. That psychological benefit can be incredibly valuable. Research consistently shows that investor behavior has a major impact on retirement outcomes. People who remain disciplined often achieve better long-term results than those who constantly react to market headlines. The bucket strategy encourages discipline. Another reason the bucket strategy may reduce required savings is because it focuses on income planning rather than account balances. Many retirees become obsessed with reaching a specific portfolio number. However, retirement is ultimately about income. The real question isn't how much money you have. The real question is whether your assets can provide reliable income throughout retirement. When retirees focus on income streams rather than account balances, they often discover that their goals may be more achievable than they initially thought. Social Security plays a major role here. Many retirement calculators overlook the importance of guaranteed income sources. Social Security provides a monthly benefit that can cover a significant portion of living expenses for many retirees. Pensions, annuities, rental income, and part-time work may also contribute. The more expenses covered by guaranteed income sources, the less pressure there is on investment portfolios. For example, consider two retirees with identical spending needs. One receives substantial Social Security benefits and a pension. The other relies entirely on savings. The second retiree will likely require a much larger portfolio. The first retiree may achieve retirement security with significantly less savings because part of their income is already guaranteed. The bucket strategy works especially well when combined with these income sources. Retirees can use guaranteed income to cover essential expenses while using bucket assets for discretionary spending and long-term growth. This creates a more balanced retirement plan. Another advantage involves sequence of returns risk. This is one of the most important retirement concepts that many people have never heard about. Sequence of returns risk refers to the danger of experiencing poor market returns early in retirement. When retirees withdraw money during market declines, portfolio damage can become difficult to recover from. Even if long-term average returns are reasonable, poor timing can significantly reduce portfolio longevity. The bucket strategy helps manage this risk. Because short-term expenses are covered by cash reserves, retirees may avoid selling stocks during market downturns. This gives growth investments time to recover. Reducing sequence of returns risk can improve retirement sustainability and potentially reduce the amount of savings required. Let's talk about confidence. Retirement planning isn't purely mathematical. It's emotional as well. People need confidence in their plans. They need to believe they can maintain their lifestyle without constantly worrying about money. The bucket strategy often improves confidence because it creates structure. Instead of looking at one large portfolio and wondering whether it will last, retirees see clearly designated resources for different stages of retirement. This can make retirement feel more manageable. Financial confidence often leads to better decision-making. When people feel secure, they are less likely to make fear-based choices. Another benefit is spending flexibility. Traditional retirement models sometimes assume that spending remains constant throughout retirement. In reality, spending often changes. Many retirees spend more during the early years when they are healthy and active. Travel, hobbies, dining, and recreation may increase expenses. Later in retirement, spending patterns often shift. The bucket strategy accommodates these changes more naturally. Different buckets can support different phases of retirement. This flexibility may improve retirement efficiency and reduce unnecessary savings targets. Healthcare costs are another important consideration. Many people overestimate or underestimate healthcare expenses. The bucket strategy allows retirees to designate specific resources for future medical needs. Having a healthcare-focused bucket can provide additional peace of mind. Rather than inflating overall retirement savings goals to account for uncertainty, retirees can create dedicated reserves for healthcare expenses. This targeted approach may improve planning accuracy. Inflation is another challenge. Many retirees worry that rising prices will erode purchasing power. This concern is legitimate. However, the bucket strategy addresses inflation through long-term growth investments. While cash reserves provide stability, growth-oriented assets help support purchasing power over time. Maintaining exposure to growth investments is essential because retirement can last decades. A retirement lasting 25 or 30 years requires ongoing growth. The third bucket is specifically designed to address this challenge. Let's discuss a practical example. Suppose a retiree estimates annual spending needs of $60,000. Social Security covers $30,000 annually. This means the investment portfolio only needs to generate the remaining $30,000. Already, the required portfolio size becomes much smaller than many people assume. Now imagine that the retiree maintains 2 years of expenses in a cash bucket, several years in conservative investments, and the remainder in growth assets. Because the strategy manages risk more effectively, the retiree may feel comfortable maintaining a higher allocation to long-term growth investments. Higher expected returns may allow retirement goals to be achieved with a smaller overall portfolio compared to an excessively conservative approach. This doesn't mean everyone automatically needs 25% less savings. The exact impact varies. However, many financial planners have found that strategic asset allocation and income planning can significantly improve retirement efficiency. The key idea is that organization matters. How money is structured can be just as important as how much money exists. Let's address a common misconception. The bucket strategy is not a magic solution. It does not eliminate market risk. It does not guarantee investment returns. It does not remove the need for disciplined saving. What it does provide is a framework that helps retirees manage risk, spending, and emotions more effectively. For many people, that framework creates meaningful advantages. Another important benefit involves retirement transitions. Moving from saving to spending is often challenging psychologically. Throughout working life, people focus on accumulation. Retirement requires a shift toward distribution. Many retirees struggle with this transition. The bucket strategy makes the shift easier because spending money comes from designated sources. Retirees know exactly where their income is coming from. That clarity can reduce anxiety. Let's also talk about market volatility. Market fluctuations are normal. Every investor experiences periods of uncertainty. Retirees often worry that volatility will derail their plans. The bucket strategy doesn't prevent volatility, but it changes how retirees respond to it. Instead of viewing market declines as immediate threats to income, retirees can rely on short-term buckets while allowing long-term investments to recover. This perspective can make volatility more manageable. Financial planning experts often emphasize that successful retirement requires both growth and protection. Too much growth can increase risk. Too much protection can reduce returns. The bucket strategy attempts to balance these competing goals. Short-term assets provide protection. Long-term assets provide growth. Medium-term assets provide stability and income. Together, they create a diversified retirement structure. Diversification remains one of the most important principles in investing. No one knows exactly what markets will do next year. No one can predict future interest rates with certainty. No one can forecast economic conditions perfectly. Diversification helps manage uncertainty. The bucket strategy is essentially a form of diversification based on time. Different assets serve different purposes. This can improve overall portfolio resilience. Another advantage is simplicity. Although the concept sounds sophisticated, it can actually make retirement planning easier to understand. Many retirees appreciate being able to visualize where their money is allocated. They know which assets support current spending. They know which assets support future spending. They know which assets are intended for growth. This transparency can improve financial confidence. If you're approaching retirement, one of the most valuable exercises is reviewing your expected expenses. Many people focus heavily on assets while paying less attention to spending. Yet spending is a critical part of retirement success. Understanding your monthly needs helps determine how large each bucket should be. It also helps identify opportunities to improve efficiency. Reducing unnecessary expenses may significantly lower retirement savings requirements. Even modest spending adjustments can have a substantial long-term impact. For example, lowering annual expenses by a few $1,000s may reduce required retirement savings by tens of thousands of dollars. This demonstrates why retirement planning isn't only about investment returns. It's also about lifestyle design. The bucket strategy encourages this broader perspective. It shifts attention away from arbitrary savings targets and toward practical income management. For many retirees, that mindset change is extremely powerful. At the end of the day, retirement isn't about reaching the biggest possible number. It's about creating a sustainable lifestyle that allows you to enjoy financial security and peace of mind. The bucket strategy provides a structured approach that can help achieve that goal. By separating assets according to time horizons, managing sequence of returns risk, supporting emotional discipline, maintaining growth potential, and focusing on income rather than account balances, retirees may discover that their retirement goals are more attainable than they once believed. While every financial situation is different, the bucket strategy demonstrates an important principle. Smart planning can sometimes be just as valuable as saving more money. The right strategy can help your resources work harder, reduce unnecessary risk, and create greater confidence throughout retirement. If there's one key takeaway from today's discussion, it's this. Retirement success isn't determined solely by how much money you save. It's also determined by how effectively you organize, manage, and use those savings. A thoughtful bucket strategy may not only help protect your retirement income, but could potentially reduce the amount of money you feel you need to retire comfortably. And in a world where retirement goals often seem larger every year, that can be a very encouraging realization. If you found this information helpful, don't forget to subscribe to the channel, like the video, and turn on notifications so you never miss future retirement planning insights, Social Security updates, and practical financial strategies designed to help you build a more secure future. Thank you for watching, and we'll see you in the next video.